A significant number of individuals seem unaware or indifferent to a matter that is increasingly becoming grave, and, in my view, has initiated a pivotal moment. Let's delve into the statistics first. M2 growth, after reaching its zenith at 27% in 2020, has been steadily decelerating. We suspect it might be nearing or even falling below 3% on a year-over-year basis, leaving minimal room for growth or inflation unless there's a substantial surge in velocity, the rate at which money circulates. However, in the current milieu, we observe a lack of momentum and velocity, with individuals and businesses seemingly growing more apprehensive and exhibiting restrained spending habits. An intriguing observation regarding M2 is its peak in March, a rare occurrence involving sequential declines in monetary figures. Despite ongoing efforts in Fed policy, we haven't surpassed that March peak, and the trajectory doesn't seem optimistic. I would like to expound further on the notion that the Federal Reserve, FED, might be making a misjudgment. While I use the term probably for compliance reasons, I genuinely believe there's a mistake in the Fed's approach. Reflecting on Chairman Powell's late August speech and drawing parallels to Chairman Volcker, it appears Powell perceives himself as Volcker's reincarnation, entrusted with curbing inflation forcefully. History favors Volcker for successfully reversing inflation, but it's crucial to note that his actions addressed a 15-year inflationary buildup starting in 1964, linked to the Vietnam War and the Great Society under President Johnson. In contrast, the current inflationary scenario is a consequence of unforeseen shocks within a 15-month time frame, such as the global pandemic and subsequent supply chain disruptions, compounded by Russia's invasion of Ukraine. Powell's approach seems more aggressive, perhaps disproportionately so, given that it's addressing a shorter-term issue with a sledgehammer 6 to 10 times larger than Volcker's. Comparing interest rate hikes, we've gone from 0.25% to 5%, a more significant leap than Volcker's doubling of rates from 10% to 20%. While Volcker's era allowed for gradual adjustments to inflation, the current situation involves swift and substantial policy shifts. The shocks faced today differ from the past, with no prior embedding of inflation expectations. Powell's actions, amplified in scale, could have ramifications. Our hope is for the Fed to reassess and consider a more nuanced approach, understanding the uniqueness of the current economic challenges. I recently had an interview where someone expressed skepticism, asserting that the current situation is incomparable due to its origin from a low base. Paradoxically, this low base scenario heightens the drama. The U.S. debt crisis, escalating since March 2020 with an additional $8 trillion in debt, has triggered a 50% surge in gold prices. Opting for gold and silver emerges as a defensive strategy when trust in elected officials in Washington, D.C. wavers. I find it perplexing that despite the absence of ingrained inflation expectations, Chairman Powell appears to be treating the current inflationary situation as more severe than what Volcker faced. The starting point being a low base is genuinely startling, especially considering the prolonged period of low interest rates. Contrary to the prevailing sentiment, this low base entails a 16-fold increase, not a mere 2-fold. Anticipating significant financial consequences due to current monetary policies, the initial repercussions have gone unnoticed by many in the United States. My experience in the UK during its near Lehman moment, signifying a financial system implosion, resonates. The issue centers around LDI, liability-driven investing, where pension funds aim to align assets with liabilities. Despite mounting deflationary pressures, U.S. government bonds held in pension funds abroad are being sold, hinting at an evolving financial crisis. As the Fed persists in raising interest rates, evident in the recent series of speeches by Fed members, the potential repercussions of this trajectory are concerning. The Fed has conveyed a commitment to raise interest rates until reaching 2% inflation. I anticipate that by then, the deleveraging process will be well underway, alleviating the maximum pressure associated with the ongoing situation. Noteworthy global shifts are occurring, with China and Japan intervening to stabilize their respective currencies. Japan's method involves selling dollars and acquiring yen to support its currency at 45 yen to the dollar, effectively providing dollar liquidity to the world. China follows a similar approach. The seriousness of these actions suggests a looming cathartic moment, likely triggered by the gilt trip. While the Fed acknowledges international ramifications, its primary focus remains on the U.S., drawing parallels with the early 80s where global accords aimed to limit the deflationary impact by collectively selling dollars. I contemplate potential weak links in the US. Pensions are a concern, given the presence of liability-driven investment (LDI) strategies, though their leverage seems less pronounced. Auto credit has been a persistent worry, underscored by the recent decline in the Manheim Used Car Index. This index, signaling deflation, has plummeted from a 54% year-over-year increase in April 21 to a minus 0.1% now. The significant decline, especially considering the importance of residual values in auto paper, indicates potential trouble. The used car price index, which surged during the pandemic, is now on the verge of collapse. Buyers, motivated by the desire to avoid mass transit during COVID, may face losses as dealers, burdened by excessive inventories and rising interest rates, are compelled to sell. With approximately $1 trillion in auto paper, while not a systemic risk, this situation could surprise investors. Another vulnerability lies in the corporate sector's substantial debt. Driven by catering to short-term shareholder demands for share buybacks and dividends, companies are becoming increasingly leveraged. This poses a significant challenge, particularly for sectors facing both cyclical and secular disruptions. The retail sector, marked by astonishing inventory buildup, emerges as a potential weak link, amplifying the prevailing deflationary risks. Deflationary indicators abound in the pipeline, starting with commodities. A critical focus we'll delve into shortly. Downstream at the consumer level, retailers find themselves inundated with inventories, exemplified provocatively by Nike. As both a retailer and a supplier to retailers, Nike has witnessed a staggering 44% surge in inventories. This increase is particularly pronounced in North America, where inventories are up by 68%, and those in transit from Asia have soared by 85%. The inevitable consequence will be price reductions by Nike and other retailers, signaling a microcosm of a broader issue. Examining the past month's data aligns with the Fed's purported data-driven approach. Historical data from the 80s, 90s, and 2000s reveals that inflation tends to decrease during robust economic periods, fueled by productivity growth. Now, turning to commodity prices, one wonders if the data-driven Fed is attentive. Gold has plummeted by 17%, copper by 30%, lumber by 73%, and iron ore by 35%. Global infrastructure, especially in China, grapples with challenges. Corn, an exception, has risen by 27%, primarily due to Ukrainian issues. On a year-over-year basis, gold is down 3%, copper 17%, lumber 28%, and silver 9%. DAM prices for semiconductors are down 33%, reflecting a 46% drop since their peak. The Baltic Freight Index has fallen by 48%, the Baltic Freight Dry Index by 65%, and oil by 29%. Container board prices, a gauge of the tight box market, are down 29% from their peak and 53% from a year ago. Despite this compelling evidence, markets are witnessing a broad sell-off, an anomaly associated with crises and a poignant indication that the Fed's stance is excessively tight. This market reaction may prompt the Fed to pivot, potentially starting with rhetorical shifts. The evidence presented here suggests the Fed will receive a clear message, transcending the lagging indicators they currently rely on. Assessing equities and bonds since their peak reveals losses for investors exceeding those experienced in '08 and '09. Notably, bonds are selling off alongside stocks, indicative of liquidity constraints. As financial pressures mount, the liquidation of government bonds, despite deflationary signals, is noteworthy. This intriguing scenario appears to be steering us toward an imminent cathartic moment, poised to generate crucial financial signals. The Federal Reserve might not have initially paid heed to the gilt trip, but it ought to, given its role in the near Lehman event in the UK. The current situation is akin to darkness before the dawn, signaling an imminent pivot. It is crucial for the Fed to move away from the insistence on unanimity and a united front. The diverse membership, including various Fed members and presidents, exists precisely for the purpose of fostering debates. Unfortunately, the ongoing debate seems stifled. While the discourse should ideally be guided by data, the unanimous consensus among Fed members suggests otherwise. National Gold Group stands out as a top-rated gold IRA dealer in consumer affairs. As we conclude this insightful journey, we invite you to share your thoughts and perspectives in the comments below. Don't forget to hit the like button if you found this video valuable and subscribe for more engaging content. Thank you for being part of our community, and we look forward to exploring more exciting topics together. Until next time, stay curious and keep exploring the vast world of knowledge.